funds rate. So it really is this very short-term overnight rate that you would think, why does a bank need to borrow? Well, they can either borrow from one another or borrow from the Fed. And why would a bank need to borrow? Everyone's got reserve requirements. Every bank has a certain required stipulated by the FDIC of reserves they have to hold. Some days it's not because it's a bad bank, but depending on flows of lending and other pieces, they may be short their regulated amount of funds. So they will go borrow overnight in the funding market. And some nights they'll have surplus, want to make a little bit of juice on it. Now, you're not making a whole lot of juice, but you're making a little bit more than nothing. And you can place that with the Fed. So really, it's setting this rate, which has been set. And it's interesting because the ebb and flow of that, we know the Fed funds rate, they always talk about is between 0 and 25 basis points. We call that 0, but it's between 0 and 25. That's their range. And why do they set a range? Why don't they just pick a spot? It's because of this ebb and flow. They want this band to afford some flexibility back and forth. But we could see throughout the entire bulk of 2020 hitting the pandemic on through where we are right now, this one rate, this key piece of and is a key, I think that's what we'll talk about, is the one thing they can turn the ratchet on. Now, we're looking at this in terms of what they call the IMM, or the interest rate product quoting convention. So you always take 100 minus the price, and that gives you the yield. Unlike small yield-based products, which give you, as you mentioned, the 30 years at 1.93. Well, I know that's 1.93%. That's pretty straightforward. Mm-hmm. Here you take 100 minus that rate, and that's why they quote things like Fed fund futures, which they do have. And it's 0.1%, which is right in the middle of that 0 to 25 basis points. But we've seen that the Fed very quickly marked basically this Fed funds down from 175, which is again 100 minus 98.4, all the way down to, let's just call it effectively 100 or zero, and has kept it there. So what does that do? Okay, they move short-term rates. What moves in conjunction with short-term rates? Well, the longer end of the curve. To what degree? That's what you and I always talk about a little bit. Mm-hmm. And that is really what we want to talk a little bit about now. So we know that they control this very short-term part of the market. We also know that they buy assets, which is something different. They buy 10-year treasuries. They buy 7-year treasury. They buy MBS, which are mortgage backed securities. Mm-hmm. So there's other ways for them to inject liquidity and kind of it tilts the scale a little bit. It's like you've got buyers and sellers. That's what creates an efficient marketplace. Then you've got this dude in there who's buying no matter what happens. But he's he's going to buy, and he really, frankly, doesn't care what price. Yeah. Now, that's a price-sensitive buyer. That disrupts the market. Is the market very liquid and normal? Yes. But that disruption doesn't create a market clearing price. So does that mean the price of treasuries or yields are wrong? Absolutely not. They are what they are right now. And that's as efficient it is given the participants that are in the marketplace. So in a nutshell, that's what the Fed controls. And so that's given how efficient
it is anybody trading this right now? Like over the next couple of days? I mean, probably not, right? Like there's really nothing to do.
You're absolutely right. It's so funny. When I was on the floor, this pit, Fed fund futures were next to the currency quadrant. I traded it, and there must have been 110 guys in that pit. And this is when we weren't at zero interest rates. Yeah. When I came off the floor, and granted it was a while ago, but we were in one of those zero interest rate worlds. There was nobody left in this pit. I mean, the product was still listed, but did it trade? No, it had zero volume to it. So when I would imagine if you look at Fed fund futures now, there's probably a little bit of option activity, because I would imagine, there are some people hedging, using that product to hedge with options. But I got to imagine that with the certainty of, takeoff or launch being whatever it is, and them stopping buying assets way before they mess with this rate, that this is pretty much, you never want to call anything a certainty, but there'll be a lack of interest in seeing what Fed fund futures do. Absolutely.
Yeah. And this is, there's multiple months, right? I'm assuming. So like, that's the front month futures that we're looking at. There's probably other months, right? Like, so there's probably a little more trading in the further out, but these are dead. I mean, nobody's trading these, right?
You're absolutely right, and it's a great point. As you go further out in time, just like Eurodollar futures, which are 90-day time deposits, a little bit different instrument than at these Fed fund futures, but depending on how far, and they go out 10 years,
Yeah,
it doesn't, which is very interesting. The market for this is a much more shorter term reflexive market, where that 90-day funding benchmark, it's really the benchmark of LIBOR. I'm sure everybody's heard that term.
yeah.
That goes out 10 years. But here we really have, as you would say, there's nothing to be done. So let's jump to the next slide, tomorrow.
And I would guess, whatever that curve, there's a curve probably for this Fed funds futures. I'm sure it looks similar. Even though we were looking at a singular future right there, I bet it looks similar to that, right? Lower in the near term, starts to go a little bit higher as you go further out, probably. I mean, I would guess, I'm assuming something like that.
You know what? You're spot on. The problem is, unlike Eurodollars, where that yield gets higher when you get out to 2022 and 2023, it shows yields not at zero. The Fed fund futures really don't go out. But something the CME does is they publish what they call the Fed funds probability tool, and they basically take Fed fund futures prices and assign a probability to it. We're all about probabilities. We love probabilities. That's our edge. Well, we can see for this upcoming meeting, the probability of them moving from that 0 to 25, and you look at that blue line, talks about that target rate, which is 0 to 25 basis points. This shows the probability of it moving. Now, a lot of times you'll see some bars on the left, which means there's a small probability it may go below 0, or bars on the right means it may increase. We see the probability for this meeting coming up tomorrow. The chances of them moving basis where the futures are priced is 0. So
goose egg.
An absolute goose egg. So we know the market's expectation, which not always is accurate, but I think this is an interesting one. When you talk about that tradable opportunity, there is no tradable opportunity right now in the short end of the curve. That certainty through 2021, that the goose egg, the zero bound, and it's interesting, if we were to have the possibility of moving into negative rates, you'd start to see that on this probability matrix. Now, I think the Fed's made it very clear that they're not going to make necessarily, I argue, the mistakes that the Japanese or the Europeans or the Swiss did, and a number of other countries move significantly into zero territory, basically tax savers. So this reflects that we're standing pat. So the other sides of as we move out in duration, we know, okay, can the Fed do to do a 10-year or 30-year? Well, it can talk about it. It talks cheap. You got 12 people on the Fed board, or 12 chuckleheads, as they call them, all with different opinions. But talking doesn't do a lot of good. What can they also do? They can go out and buy some assets, which is what they're doing right now. Can they buy more if they want? Sure. But I forget how many $1 trillion their balance sheet is, but it's not small.
Oh yeah, no, it's a huge, it's 5 or 6 trillion maybe. Something like that, right?
I think so. So, but that's where the interesting part of the talk and the dialogue and the market itself start to play an interesting role within that. So, I think tradable opportunity for you and I will be in those longer dated instruments.
Mm-hmm, mm-hmm. Yeah, we can. I think there's a slide that shows. This is a great tool, by the way. That CME tool. I can't lie. I've often looked at it too. Because we look ahead. I think this is what we'll see in situations going further out, right? Like, this actually shows you. Oh, these are where people line up potentially where they think rates are going to be at this time. What is it? Oh, this is for February 2023. Okay. So now we see here, right? Like now you see these are the percent chance where it stays where it is right now. You see a lot more people are starting to think we're going to have at least one rate increase, maybe two, right? Probably. So yeah, I mean, this is always a great tool to look at to get an idea of where expectations are for rates moving at some point in time.
Absolutely. And so this is for the Fed. Each one of these markets or the expiring months, as you mentioned, coincides with a meeting of the Fed. So this is for the Fed will have a meeting on February 1st. It's 2023. Remember, we're not talking about 2022. We're talking about 2023. And you see that here the probabilities have moved. there is still the overriding probability that even 2 years, or what would we say, a year and a half from now, we're still going to be in the zero interest rate environment. But the market is starting to price in different parts. Now, will these probabilities change? Probably with some of the speak out of this meeting tomorrow. And remember, it's kind of a two-hitter. There's a announcement that's written that comes out at 1 o'clock, then a press conference from the chairman at 1:30. But here we're starting to see uncertainty play into the markets. Where do we want to be? We want to be where the uncertainty lays. And that lays at either longer term, longer dated short-term interest rate products, which is what these Feb 23 ZQ futures are, or Feb 23 Eurodollar GE 90-day time deposit futures are those longer dated yield curve, yield plays.
Yeah. And, this isn't set in stone at all. I mean, like you said, this is going to move probably, over the next couple of months as we start to hear more from because what we've really had to rely on are the press releases at the end, like them talking, the rhetoric that they say over these last couple of months. Like we said, I mean, I'm not tuning in to listen to that crap, but it's the wording that really kind of people want to know. How nervous are the Fed? How much longer are we going to be, in the state that we're in? Like you said, we're buying these mortgage-backed securities, having $120 billion a month of, of Fed aid that we're getting. How long are we going to be this lower interest rate environment? Because of course that affects the options we trade, that affects a lot of other, equities and futures, et cetera. So I think that's always the big thing. What's going to happen in the press release? What is he going to say? I'll catch the Cliff Notes. I definitely, there's no damn way I'm watching that thing. I never do. So, but it's really interesting, right? Like that's what we really want to know. Everybody's like, okay, yeah, we know interest rates aren't changing. What's going to happen a year from now? Tell us. Right. That's basically what it ends up being like.
Right. And it is. It's a summation of the state of events and where they think bias lies. And, I got to think the worst job in the world is, for me, it's not the worst. It's a great job trying to figure out where rates are going to be in the next hour or day. The worst job in the world would be trying to guess where they're going to be in a year. I look at these economists and I'm like, man, and I'm sure they're getting paid a lot of money, but trying to guess where crude is going to be at the end of the year. You see the prediction from Goldman and from, Jefferies and all these big firms. I don't know how in the world you come out. And inevitably, I would imagine the probabilities of them being within $5 of the actual price of crude are slim and none, but God bless them for trying. But, I think you made a great summation there. We're going to look for changes in the subtlety around this longer period of time. So where are your eyes going to be as we unfold tomorrow at 1 o'clock, Jermal?
Well, for the most part, I'm probably going to look at, honestly, I don't know how much it's going to affect the current market that we exist in right now. Like we said, what they're talking about is some time from now. I don't expect the rhetoric to change a whole lot from what we've seen in recent meetings. There's been a lot of data, they factor in a lot of data that we've gotten over the last month since we had, a meeting, however long it's been. They factor in CPI, they factor in unemployment. They've maintained that whatever's going on with, the joblessness, that's what they're really paying attention to. So, where's inflation? Well, that talk of inflation, I think, has died down quite a bit, right? We've seen that die down dramatically and drastically. If you look at lumber prices as a proxy for what inflation was being, well, lumber prices have gotten whacked. So, that's just one of them. So that's something that they were, I think, talking about the last meeting that, I bet they're going to say, it's not as much of a fear, but now you got to wonder if they're going to talk about the Delta variant. I hate that. I almost feel like I have to throw up when I said that because I know everybody's talking about it right now, but that's what's being talked about. And you'd wonder, I'm sure people are going to look at the release and wonder what they're going to say about that. So, I think those are the things that are going to create, the narrative for the market going forward, whether the net market is nervous after what is said. I feel like the last couple of meetings though, the next day we did move. I feel like the last two. So, it's definitely going to create some, mini volatility, if you will. Hopefully not too much. I shouldn't say hopefully. Hopefully not too much for those who are caught the wrong way. But at the same time, those type of movements create opportunities for trading. So
absolutely. And let's jump to the last slide if we can tomorrow. And you're spot on. So When we look at that short-term rate, we're seeing that 2 years are really priced, right in the middle of that short-term rate. So 2 years are acting like a Fed proxy. Remember, 2.0 is 20 basis points. So it's when we look at that Fed band of 0 to 25 basis points, where are the 2-year treasuries? They're right in the middle of that band. So what's kind of a proxy for that treasury? Yes, there are Fed funds or the Fed doing something. The Fed funds futures are, but they're kind of funky. They've got like a $56.37 tick. I forget what it is. I know that isn't the right number, but it's something like that. It's completely bizarre. But this is the straightforward way. If you want to trade the Fed speak or the Fed dialogue, these 2-year treasuries are the way to do it. And I agree with you. I'm not listening to the speech. I'm not listening to the press conference. Market's going to tell me everything I need to know.
Yep.
So great walkthrough, Jermal.
To your point too, like that big move that we saw in that chart, that was the last meeting, right?
It was.
So we saw short-term rates shoot up because of what they were. I don't know, something they said. I don't even remember exactly, but that's the thing that's really going to move it.
You know what? I think you just hit on it too. And it's everybody wants to be a little bit of a fundamentalist, and you fight that urge and let the market decide. But when you said, I don't even remember what they said. I think that's the perfect. Nobody does. Everybody would have to go back and look. And then, if you think about it, you do remember where the market is, and you remember the ranges. But what the chucklehead said, in the long run, isn't material to what we're looking for, which is opportunity. And I think we're going to keep going back to that. You know what? These events of themselves are not predictive exercises. They're movements of volatility and opportunity.
No, nobody remembers. You don't remember. I don't remember, because we're not economists. We're traders. Like you said, we look for the market to tell us what we need to know, and we move off of that.
Good deal. All right, my friend. I will see you next Tuesday, and I know you'll be back. Jermal will be back with Frank on Thursday for the latest edition of The Leap. Guys, thanks for tuning in, and stay tuned for Splash into Futures.